Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst, investment banker, and the very best independent analyst you will find on Wall Street, and a friend of this show. Gosh, Chris, I can't think of a better time to have you on. What a week it has been with Liberation Day, tariffs. We got the jobs report today. So much happening. So thank you so much for taking the time to join me today.
No, always a pleasure.
Well, you are certainly a fan favorite, and we look forward to it every single month. And so I'm just kind of looking today, just for folks who are watching, listening. We're recording on Friday, April 4th. It's 10 a.m. Eastern, and markets are selling off once again. We have the Dow, the S&P, the NASDAQ. Every major indice is much, much lower today. I saw that oil was down big today. It's around 61.23 a barrel. We have a 3 handle on the 10-year today. I'm looking at the 10-year. 3.94 on the 10-year. So much happening. So can we just kind of step back, do more of your big picture, your take on this week? What's been your reaction?
Well, I view the tariff conversation as a bit of a distraction. The finance minister of India had a great interview in the FT a couple of weeks ago in the weekend edition. And he said, you know what? The Americans are tired of being the global engine of growth. They're tired of running the global currency, which we have discovered is rather expensive. So Trump is trying to change this. He's trying to bury Bretton Woods once and for all, 75 years later. And as I've said to my readers, I said, look, this had to happen. No country can bear this burden forever. So I think what we're going to see is a slow migration back to a multilateral world where people are going to have probably more incentive to hold currencies of their major trading partners and neighbors than necessarily the dollar. The dollar will still be very important because it's so big. That's why people use it. The other currencies of the world, the next one would probably be the yen. Nobody's rushing to use the yen as a means of exchange, right? Julia, you and I have followed the markets for a long time, and the Japanese don't want that role. Neither do the Swiss, neither do the European community. So it's a job that finds you usually after a war. And what Donald Trump is saying is that we need fairness in our relations with other countries. We cannot always be the deficit nation. And I think that's obvious.
Mm-hmm. Do you think that what we're seeing, is it an overreaction? Is it an expected reaction? Just what we've been seeing in the markets.
I think it's a bit of an overreaction just from a market perspective. If you're looking to do asset allocation, what I've been telling my readers is that this debate over tariffs is a bit of a distraction because Trump is doing this deliberately. He is using shock and awe to get our neighbors off the dime and come and talk to us. This wouldn't happen otherwise. If you didn't put a gun to the head of the Europeans, they wouldn't respond. Well, they're responding. So Trump has kind of turned the card table over, and he's saying, no, we're going to use different rules from now on. And that confuses and I think puts some fear into the minds of investors and whatnot. But the reality is, I think we should be looking at stocks and doing our homework, Julia. This is not necessarily a day where you want to be a buyer, but you want to be thinking about it because my financials are still expensive. We still have not retraced back to, third quarter last year. Financials tore 50, 60, in some cases 70% in the second half of last year. That was not exactly normal, right? Remember, we were talking about rate cuts in September, and my lenders killed it. My lenders had an awesome quarter in the third quarter. Fourth quarter was okay. Now the first quarter of this year is kind of light. And I think you're going to see credit higher and volumes lower. Which is, not a happy prediction, but we haven't had much growth in financials. You saw this with Jamie Dimon in the fourth quarter. If you go back and read his comments during the call, he said there's no loan demand. I may have to give this money back to my shareholders in terms of higher, stock repurchases. So that's kind of where we are. I think credit will be the big story this year.
I want to get into credit too, but it kind of makes me wonder too, Chris, maybe not being a buyer today, but maybe it does open up a bit of an opportunity. I mean, I'm kind of looking at, I'm not an investor, but when I see things that are off like 40%, I don't know, it kind of looks a little interesting to me. And maybe there is an entry point at some point here.
Well, look, the laughing point I've had for a while is that I'm back to my exit point on NVIDIA.
There you go.
So,
But you got
but
out.
I wrote it up so much, it kept getting to be a third of my portfolio, and I had to pare it back.
Yeah. Yeah. One more question on well, maybe not one more question, but on the tariff front, you mentioned like Bretton Woods. There has been kind of some chatter around this idea of like a Mar-a-Lago Accord, because I know they're usually named after hotels, right? So we had
Yeah.
Jim Bianco was talking about this. Jim Rickards has talked about this. Do you think that's more of the bigger plan here? Do we need some sort of reset or accord? Like, what do you think is more of the end game
Well,
here?
everybody hopes that we have a deal because investors like to have stability. They don't like to have the chairman of the Fed, for example, stand up at the last press conference and tell everybody he's taking his GDP assumptions down, because
Mm-hmm.
that one data point ripples through everybody's model. You lower economic activity, you raise credit costs, you do all sorts of things with a lower GDP number, right?
Mm-hmm.
So, sure, everybody would like a deal. I just don't know if that's a realistic goal in the short term. Because, for example, the Europeans have more trade barriers with one another than they do with us. They have to have a conversation about that. And in part, that's what Donald Trump is doing. He is forcing all of these countries to have what's, a difficult conversation, but it's necessary. And I think, are we going to have a deal this year? I would doubt it. The big issue this year is taxes and spending. They hope to get that wrapped up by August. The trade thing, I think, is a medium-term game that will go well into the first half of Donald Trump's term.
Mm-hmm. You wrote, okay, so for folks watching, listening, we've talked about this a lot, but Chris wrote the book Inflated, and the second edition is coming out in
May
May. So go
16th.
go ahead and pre-order, folks.
Yes, please.
And I know you as you're a prolific writer, but you're a historian of financial markets, and I know tariffs are in the book.
Oh,
So
yeah.
when you're looking out there and you're seeing all of this commentary, I open up Twitter and I'm just like, I don't even know what to make of it. So much commentary. What are you
Yeah.
seeing that folks are maybe getting wrong?
I think first and foremost, you have to remember that Democrats wrote the history of the United States over the last 100 years, especially after the New Deal. Coming out of World War II, the government had such a powerful influence on perception and news. All the media worked for the government coming out of World War II, Julia. And you had big banks, big corporations, they had all come together to defeat fascism. Okay. It was a national effort. So over time, I think conservatives have tried to refute some of the core assumptions in that narrative. But basically, if you look at the US, it was really the repudiation of gold and the seizure of private gold by FDR in 1933 that broke the link between money and inflation. In other words, that was what gave the government the ability to expand. Nixon is often remembered in the early 70s for closing the gold window, but that was kind of the last detail. So for me, I like to remind people in the book that we've had tariffs in this country going back to the inception of the Republic, and it was to protect us from European competition, predatory competition. Now we have China, which is not much different. In fact, it's a little bit more concerning because they are a modern predatory mercantilist state. They're like Great Britain on steroids. And they are trying to essentially dominate the world in terms of market share. They don't play by the old Anglo-Saxon Western rules of commerce and fair dealing. Not at all. So how do you have a relationship with a country like that? And that's some of the stuff we talk about in the book. I think people get tariffs wrong. There's nothing wrong with tariffs if the other guy is putting tariffs or non-tariff barriers on your products. What Donald Trump is saying to Europeans is, let our products in, and then we'll talk. I don't know that the Europeans are ready for that, but I do know that this process, Julia, is going to force the Europeans to come together. And the Ukraine and all the rest of it, that's a good thing. Germany has discarded their limit on debt issuance, which they had to do anyway. It's funny. It really is. See, look at the debate on tariffs. We keep coming back to this 19th century view that says it's going to be beggar thy neighbor, the race to the bottom, that kind of thing. No. In the modern era, it's about expanding your currency and attracting other nations to your market. Why do people use the dollar? Because it's big. Do they
Mm-hmm.
worry about us with a big deficit and big debt? Yeah, but they kind of like it. The fact
Mm-hmm.
that you can trade oil and large commodities in dollars without any problems is remarkable. And there's very few other currencies you could use for that, by the way.
Mm-hmm. Okay, so let me ask you this then. Part of is this is Trump prioritizing Main Street over Wall Street.
Well, that's the narrative. We'll see.
Okay.
They're
Do you
talking
buy that
about
narrative?
taxes on millionaires, getting rid of carried interest for private equity. That would be interesting.
Mm-hmm.
We'll see.
This is another like really basic question, but I've had different folks with different views on tariffs. Like some will say, they are inflationary and it's the consumer that gets hit. Others say no, like um the producer or I guess the sellers of those goods, they'll eat up the cost. How do you see like more of the impacts of tariffs and who really feels it?
Well, we all feel it. But you got to remember there's two sides. If there's a non-tariff barrier in Germany that prevents me from selling my products there, that's a cost.
Mm-hmm.
They're imposing a cost on me because I can't access that market. So whether I impose a tariff on someone or they have a block in front of me, an obstacle, they're all the same. Net, can we figure out what all this means? No, it's a far too complex equation, although economists love to talk about it. See, there's a whole class of people out there, Julia, who can talk about tariffs all day long. It's like
Mm-hmm.
talking about monetary policy, right? These same people can't talk about credit or markets or stocks with any specificity. So tariffs is welcome in the media community because they can talk about it and they don't have to say anything. It's all just, wah, 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 wah.
So as
I'm
you put it,
telling my clients, do
it's a
your homework.
distraction.
Yeah,
Yeah.
this is a distraction. We're going to have a deal on tariffs within 18 months. All of
Mm-hmm.
these countries have to do a deal. And Donald wants them to come to Mar-a-Lago, bend the knee, and do a deal.
Mm-hmm.
You know, people have to remember something about Donald Trump. In a lot of ways, he's similar to Vladimir Putin. These are anti-liberal movements. Okay. And that's how you should understand them. They are rejecting much of what we call classical liberalism in the 20th century, which was a construct of the Democrats. They ran the New Deal. They ran the US for many, many years. So they wrote that narrative, and Trump is now rejecting that narrative. That's why people are so confused.
Monetary Metals offers you the ability to grow your wealth outside the banking system and gain greater control over your finances through gold. Increase your precious metal ounces every single month. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities to earn 4% on gold, paid in gold in their marketplace. And the interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. You mentioned the focus turning to credit. I do want to bring up credit because I know that sounds like that's something you want to talk about. And you put out a note. And speaking of like consumer credit, I just want to point out for folks that you, Chris, you were cautious in 2024 about calling a consumer recession, while many
Yeah.
others were out there going back to like 2023 calling for one. It didn't happen. But
No.
maybe it sounds like 2025 might be different. Can we hear your point of view there?
It's in the data. At the end of the year, there were only two consumer lenders in our surveillance group that we wrote about for our subscribers that were up, and that was Capital One and Synchrony. Synchrony is a very high spread, high risk consumer lender that runs white label programs for a number of big companies. They are kind of the bleeding edge of consumer finance. If you want to watch what's going on in the economy, you want to watch Synchrony. Now, they were up a little, but not catastrophically at all. Capital One was up a little, and the rest of them were all down. American Express, Ally, a whole host of other lenders. And you look at this and say, is this a head fake from the Fed? And I think the answer to that question is yes. The Fed pushed the cost of credit down to zero in 2020 and 21 with low interest rates. You had auto loans in terms of loss at default going to zero. Auto prices, by the way, remember, used car prices went through the roof.
Hmm.
And that meant you couldn't lose money. You just repossessed a car and sell it. So today the market's normalizing. The worst asset class out there for banks right now in terms of loss severity is multifamily housing, incidentally, and the volume of default there is going up. But the two sectors I'm looking at right now are autos and credit cards. They're both slowly starting to show what we've been waiting for over a year.
Hmm.
And I think that's going to affect financials because think of it this way, Julia. Deposits aren't growing. Jamie Dimon was talking about this very eloquently. So we're not getting a lot of loan growth, and we're not seeing a lot of demand from customers of banks. They're just not demanding credit. So if credit costs go up in the first quarter, what happens to earnings? They go down because we don't have a lot of top line growth in the industry right now. The Fed has slowed the balance sheet reduction. That means bank deposits are going to grow a little bit. But I don't think it's going to be gangbusters by any means.
Hmm. Okay. You mentioned multifamily and the volume of defaults. Is this like this vintage of like subprime? Is that the?
It's smaller urban properties that may have been rent controlled or rent stabilized. Think of Signature Bank. There's a whole pile of stuff that's sitting inside the FDIC's bank insurance fund left over from Signature Bank that the Biden administration didn't feel like selling. They will sell it, and they're not going to get much for it. The market indicators for those types of properties in New York City are at least 50 cents on the dollar below the last sale. Okay.
Mhm.
And again, these are smaller properties. They're just too small. New York City, running a building has a certain cost. So you have to have X amount of square footage to make the building work. We should be knocking down half of Manhattan and redeveloping it because those buildings were built by my ancestors, by the way. And it's time. They're 150 plus years old. They're too small. And, we need another Robert Moses. I hate to say he's a very controversial figure, but he got stuff done.
Yeah. As you pointed out the last time, like the math just doesn't work out for those buildings. You
Oh
can't do the,
no, no,
yeah,
no,
the,
no, no. And yet, the capital, new money's pouring into New York, Julia.
Mhm.
Everybody thinks it's great again. And we see overdevelopment all over the country. If you look above the average home price in the Southeast, Southwestern states, the amount of overbuilding, speculative overbuilding in both single family and multifamily properties is impressive. We're going to have to work it out.
Mhm. When you say that, like the overbuilding, are you also, when you say the multifamily, are you referencing like these kind of just like what I'm in right now is an apartment building, like more of these,
Hmm.
feels like there's a lot of them going up. I'll tell you
Oh
this,
yeah.
my apartment building sold like suddenly, just like a
Hmm.
couple weeks ago. We have a new owner now, and I don't know the
Hmm.
details on that, but it was very fast. Um,
It's
so
because of where you're located, Julia. You're seen as being in a safe, positive area where there's employment growth, income growth, right? You don't see people putting up new spec properties in New York unless there's a subsidy angle of some kind,
mm,
or it's in the city. The
yeah.
city rentals are still pretty strong, but they come and they go. It's episodic. I would tell you, single family real estate in New York has kind of gone back to where it was before COVID, low volumes. The sale prices are okay, but they're not like 2020, 21 by any
Hmm.
means.
Um, on the consumer side, do you see a consumer recession ahead?
Yes. Yeah.
Can you
And it
elaborate
may be
more?
sudden. The indicators have been subdued and in part suppressed by monetary policy and also fiscal policy. We've written about the fact that there are hundreds of thousands of people sitting in various loan modification and forbearance programs in the FHA. Those are going to have to be resolved. These are people who failed modifications 2 and 3 times. And during the Biden administration, the industry just kept them there. They would just advance principal and interest to the securities, and the loans would sit there in limbo. And obviously the issuer, the servicer, would have to finance all of this, right? Now I think you're going to see the industry resolving more of these, and it's going to be painful. These are people who got kicked around during COVID, Julia, and they never came back. They never got back on track in terms of jobs and what have you. So the good news is that home prices are so strong that when somebody gets to a foreclosure, they sell the house and they give them the net proceeds, which is what they should do. That's a forced sale. And that's why the default numbers don't look so high, okay,
Interesting.
at the moment.
Okay. So it seems like maybe there are more people who might be delinquent with their
Yes,
mortgages than
yes.
people realize.
Well, FHA is reporting 11% delinquency right now as of the fourth quarter. I
Hmm.
would tell you it's closer to 14 or 15, and that's a problem because at that level of delinquency, those portfolios are negative cash flow. And so
Hmm.
if you're a big servicer, you have to be concerned about that.
And as you point out, like housing prices are still strong, but
Yeah, yes. In the bottom half, yes. Top
okay.
half, no. We're seeing considerable softening above that average four or $500,000 house.
Hmm.
You're definitely seeing the market slow down.
Hmm. Yeah, I've noticed like certain properties. Again, I keep just watching, and I'll see like, oh, that house just got cut by like 40,000 or something. Like I'll see like prices come down, but
Or the new stuff will flip to rentals. When you see
mm,
them starting to push rentals instead of sales, that's a classic sign.
hmm. Um, okay, so consumer recession, how is that different from like prior recessions, or what are kind of the signs to look for? What would this mean for folks watching and listening?
I think what's interesting is that, Powell was talking about how the volume of job loss and job gains on both sides was relatively low. And I think what that says to me is that people are really focused on keeping a job, keeping income in the household. My friends at MBA, by the way, have told me that they see people prioritizing mortgage payments instead of things like car payments, which is what they did in 2008. So there's a change in the tenor of consumers, much more cautious. And I think we could see a lot of pain in terms of credit. We may not actually slip into a recession, though. That's the funny part. You may not see employment go in that kind of classical sort of way that we've seen in past recessions. So, for the Fed, it's a difficult call because on the one hand, they know that there are sectors of the economy that would really benefit from low interest rates. Private equity, for example, where we have a train wreck going on with many of these portfolios that cannot be refinanced. You
Hmm.
also, by the way, have a lot of lenders in many of these markets, what I call hard money lenders, who are typically the ones that buy assets after foreclosure. They're getting kicked around too, because whatever debt they had in 2021, which is cheap, right, is now twice as much. The rates for loans like that is 7, 8, 9%. And
Hmm.
so when you look at that, the portfolio doesn't work anymore.
Yeah.
There's also a lot of people who've withdrawn from many wholesale markets, a lot of banks, a lot of non-banks. The mortgage industry is shrinking dramatically. You saw that transaction with Mr. Cooper and Rocket.
Yes, I
You're
saw
going
your
to
note on
see,
that.
oh yeah, you're going to see more of that. The industry is going to consolidate down to five big lender slash servicer groups, which is kind of what everybody wanted. They wanted big, muscular non-banks. That's what you're going to get.
Yeah, on the Fed front, what's more of your outlook for the Fed? More rate cuts on the table now? Like how do you think how do you think that this plays out in terms of like the Fed and their moves this year?
I think the markets are way ahead of the Fed. I've been watching the 10-year fall
Hmm.
and indeed the mortgage market too. The 5.5 Fannie for next month, which is where people are going to sell loans, is at par now. They're probably still selling loans in the sixes, but my point is they're going to be writing 6.5% loans or 6 3/4. And that's good. But the market's way ahead of the Fed. The market's been taking rates down. They blame it on Trump. But I got to tell you, I think there are a lot of other factors behind it. And every time we've gotten the 10-year up close to 5, it comes back.
Hmm.
So I think that retracement is still what we're going to see for most of the year. I would not be surprised to see no actual changes in Fed policy this year, other than I think stopping the runoff of the balance sheet. It's remarkable to me, Julia, how many economists will just discard the balance sheet as a factor in monetary policy. They want to talk about targets. And it's like, guys, the balance sheet on the one hand, from the Fed's perspective, and then what the Treasury is doing under Scott Bessent and the reductions in outlays that have been engineered by the Trump people. What are they doing? They're trying to reduce the size of auctions so they can force rates down.
Hmm.
So if the street sees the Treasury is actually going to need less money in the second quarter, that wasn't the case in the first quarter, obviously. We had record deficits. That's going to start to affect rates. Because believe it or not, the collateral markets are pretty tight. Buying
Interesting.
certain coupons right now is difficult in size.
Huh.
So the demand for risk-free assets continues. And that's why the dollar is so popular. People can do trades in the dollar. They can get Treasury securities to collateralize swaps, right? Most other currencies, you can't do that.
Mhm.
So no matter how we screw up on the fiscal side, people seem to want to use their money.
Yeah. Let me get your reaction to this because as you're mentioning, the 10-year, it's at 3.9,
Yeah,
and maybe there are other factors. I want to point out a tweet from Kyle Bass. He has been on this program a couple years ago. We'll have to get Kyle back on, but
you
I flagged
should.
a tweet. He said, I find it fascinating that not one single financial commentator has referenced the massive sucking sound of the decline in the Fed's balance sheet as one of the primary causes of the stock market rout. 2.3 trillion primary liquidity has been removed so far. Is that what you're getting at? Is like folks aren't looking like maybe there are other factors at play. It's not just like tariffs. Maybe it's what's going on with the balance sheet.
Well, Kyle, he's making a point that I'm not sure I agree with. Technically, changes in the balance sheet should not directly impact stocks. That's the classical
Hmm.
view. If we had Bill Nelson from Bank Policy Institute on, who's great, by the way, he would tell you that. On the other hand, quantitative tightening, which is what Mr. Bass is talking about, takes cash out of the system. So if I'm an investor, the Fed gets paid off by the Treasury on that T-bill, right? The Treasury has to issue that T-bill immediately. They have to replace it. So the investor buys the T-bill and a bank deposit disappears. So in that sense, Kyle is correct. There is less money out there. And if I, as an investor, choose to buy the T-bill instead of buying stocks, then you're going to have less money focused on stocks. It's really hard to say net net, but what you can say is that quantitative tightening, which is why they talk about it on the FOMC, right, is a big issue. And I think economists ought to pay more attention to it.
Okay, I want to go back to the bond market, and specifically U.S. Treasuries and the 10-year. Can you explain like how you're thinking about it? Because I know Besant wanted to get the 10-year lower.
Well,
Um, can I get more of your outlook on the 10-year? Do you think do we go back up to 5? Like, is that what you were saying earlier? Would love to hear more.
I think they can range trade depending on what's going on. Right now, people are risk off on stocks and other assets. They're also fleeing the carnage in private equity. So Treasury securities are obviously going to be very well bid. People are looking for a place to hide. Also, high quality corporates, Ginnie Mae's, everything. The whole interest rate complex, I think, is going to continue to fall in terms of cost. So when people say to me, oh, Chris, the Fed's going to cut rates 2 or 3 times this year, they already are. The Fed doesn't have to do anything, Julia. They just get to sit back and watch, which I think Powell would welcome right now because the data he's seeing is all over the place.
Hmm.
The employment data, the other data. So to me, if things calm down and we start doing trade deals, I think you could see rates back up. But again, remember what Besson is trying to do. The whole point of the Trump cutbacks in Washington is to reduce the cost of government and thereby give the Treasury some breathing room in terms of how much money they have to raise for the next refunding.
Mm.
If the Treasury general account has more money in it than they were expecting in the second quarter, that's going to be good for rates because this market wants paper. They want risk-free collateral for a variety of reasons. And, the banks haven't been growing very much. That's taken some demand away from the market. But I think, the money market funds have been growing hand over fist. They've been the big beneficiaries of the past couple of years.
Mhm.
So, I think the people are looking for a place to hide right now until they figure out what the new rules are. And it's not at all clear. The media is having so much fun with this, Julia. You know the way the media is. They keep spinning all of these tales. And yet, at the end of the day, this is all about shock and awe. The Trump people are just trying to get a deal. And 18 months from now, I think people are going to be kicking themselves if they weren't looking at stocks.
Well,
My banks aren't cheap.
yeah.
JP is, 2.1 or 2 times booked this morning. That's not cheap.
Mhm. Well, you were the one you pointed out the shock and all the last time you were here. Before I
Oh,
let
we
you go,
continue.
yeah.
Listen, we impose tariffs on countries that have no people. They impose tariffs on Diego Garcia, which is basically a U.S. military base. My friend Jim Lucere at Cap
I learned
Alpha
about
writes
places that
about
I didn't
this
even know
stuff.
existed. Yeah. Oh man. Let me ask you this. Before I let you go, I know you have a call later. What are folks asking you? Like, what's the common question that you're getting, from investors these days?
They want to know where to go. You had a long period of time when both stocks and fixed income instruments were both going up in value, and now you have them going down. Even though you could argue over the last 12, 18 months that many stocks are still not particularly cheap, this kind of reversal, Julia, as you know, is very, very negative for managers because the clients are going to look at the managers and go, well, what are you doing for me?
Mm,
So that to me is the big pressure in the marketplace. You have a lot of people trying to figure out, should I bail out and put my clients into risk-free assets for a little while? Should I be a buyer? Should I be wading into some of these better performers? So that's really, to me, what people have to ponder. And my
mm,
readers, they ask me that almost every day, but we're going to have our call later, so we
yeah.
get to hear their questions, which is what I find interesting.
Yes, absolutely. And I have to say, Chris, I always say it, but we just love having you on. I love listening to you. I love learning from you. I know this audience does as well, and we're just really grateful for you. Before I let you go, um, obviously, like, everyone go pick up Chris's book coming out
Yes.
May 16th. You can pre-order it now, but let's leave this audience with some parting thoughts and let them know where they can find you, support your work, read more of your work. The floor is all yours.
Well, thank you, Julia. I appreciate it. Yes, please, everybody go out and pre-order Inflated. We're doing very well. I just had a meeting with the guys at Wiley yesterday. They did an awesome job on the book this time around. I have brought Allie Rickards back in. She promoted all of her dad's books, and she's going to be helping me with
Wait, so
promotion on
is that
it.
Jim Rickard's daughter?
Yes.
Jim was just on the show this week. Yeah.
Yeah. No, Allie's great. She's a real pro. She knows the industry inside and out. You can find me at the Institutional Risk Analyst. I also write a column for National Mortgage News, and I'm active on X and LinkedIn, which I think are two good groups. I also occasionally post stuff up on Zero Hedge, and I am going to start doing original pieces for them again because it's so much fun. What a crowd!
So fun. And look, for folks watching, listen, we get Chris at the start of each month, so we were really grateful, and it's my favorite time of the month. And Chris Whalen, thank you so much for being so generous with your time, all of your knowledge, your wisdom, your ideas, your insights. Really appreciate you. Looking forward to seeing you in May.
Thank you, Julia.